Thank you all for coming, and thank you all for coming. This is a big panel, and I don't mean merely by the size of the number of people on stage, but it's also their stature. Really privileged to have all of you here with us today. We're going to talk about the rise of the Indian Spring, which actually has multiple facets, like we were discussing the other day. And what we'll do is, for the interest of making this trying to make this a sharper discussion, we will revolve this whole thing around 4 or 5 props, you might call them. Right? So we'll start with economic growth. We'll come to investments, which is the core of the event here. Then we'll talk about innovation and entrepreneurship, jobs and skilling. And we'll talk about risks, right? What are the risks to the Indian Spring? And if you have questions, I hope we'll have time for that. And so let's start. We'll start with economic growth. Economic growth in India has been steaming along, right? Like a roller coaster. It's been moving really fast. Q3 GDP growth was very, very surprising. A lot of people said that, okay, 8.4% in Q3 sounds good, looks good, but, GVA was 6.5, so you really should be looking at GVA and not GDP. And also the predictions for FY25 have been slightly on the lower side from all agencies concerned, right? So we'll start with Mehul Pandya, CareEdge. Mehul, you'd like to talk to us about what you think about this whole issue of GDP versus GVA and where are we headed in terms of economic growth?
Yeah, good afternoon all of you. First of all, it's wonderful to be amongst all of you today and discussing on this very important point of deliberation. You are right, there is a disconnect between the GDP and the GVA numbers, but to a significant extent, the GVA numbers were on expected lines. Yes, GDP numbers, they came as a positive surprise. Right? But all in all, what we feel is that for FY24, our own view would be, we will be staying to around 7.6, slightly upwards on that, right?
Okay.
And with that kind of a backdrop, we could be thinking in terms of around 7% for FY25.
Okay.
We do feel that some of the aspects that shall play out very crucially for this to happen. First and the foremost thing is that the thing that we witnessed, especially as far as the rural demand is concerned, the impact on that, few of the drivers in terms of the deficient monsoon, which played a part on that, right? As well as the weak consumer demand, which is impacting the overall growth, especially the corporate capex cycle, which is yet to kick in primarily because of the weak consumer demand. If these aspects are then taken care of, and if we could be witnessing, as is the prognosis for fairly normal monsoon in FY25, which could potentially be helping the rural demand. In that case, the 7% prognosis that we are having for FY25, that can potentially be bettered. But putting the entire thing in the context, we are absolutely confident about the trajectory which shall remain upwards. We are also confident that the potential headwinds which could be there, we will not be remaining immune to that in totality, especially from the geopolitical side. But nevertheless, I think we should be in a position to a significant extent, mitigate that and sustain the 7% growth for the future.
Awesome. And of course, you said 7.6, which is what the government of India has also said. And the RBI governor has said 8, closer to 8, right? And somebody else also said, yeah, maybe closer to 8. Devina Mehra, what's your view on this whole GDP, GVA and 7.6 versus 8 debate?
Yeah, it is just a matter of which side you are looking at it. So as you said, the number was far ahead of what was expected, no doubt. And also, if I ask people in this room, you would say things are looking very good. My friends are buying new homes. So when I go to order a new luxury SUV, there is a waiting list. So that's one part of the story. The other part, of course, is that 80 crore Indians need free ration, which shows you what's happening in the bulk of the economy. There was that inequality report recently, which of course showed that 65% of the wealth in the countries with the top 10%. 20 years ago, it was 40%. And at that time, the next 40% had also 40%. So now it is like the top 10% has 65, then the next 40 has something like, maybe 22, and the bottom 50% has something like 13%. So the inequity is increasing. Consumption is my major kind of concern area, because consumption growth is sub 3%. Last time it was this low was 2002-03. So after 20 odd years. So GDP has been running on effectively a single engine, which is the government spending and on infrastructure and otherwise. So we need to broaden that. And some other things like manufacturing, if you look at, again, manufacturing is now 13.5% of the GDP. Last time it was this low was 1969. So, the consumption will grow if employment does well, and some of these indicators, not that great growth in manufacturing, exports, etc., also point towards why employment opportunities are not there. And what also worried me was that the employment figures, if you look at, it is showing higher employment in agriculture. And as page 1 of any economics textbook tells you, that that is disguised unemployment, because countries progress when people move from out of agriculture, not into agriculture. So those would be, as I said, the top line is what the top headlines look very good, but if you parse it out, those are the areas we work on as a country, and I hope we do work on it and have growth which is sustainable. That's the important part.
I don't know if you saw the HSBC data talking of consumption, because they had a report saying that India's GDP data may actually be understating the consumption growth that's underlying.
You're asking me?
Yeah.
I haven't seen that. I mean, maybe it's a hangover from my sell-side days that I don't look at other people's reports for this kind of thing.
You should.
And I mean, because often there are agendas. I'm not talking about this report in particular. As I said, I haven't seen that. But I mean, those are the figures. And not only that, I mean, I remember in around Diwali time in Mint itself, there was a long story which was actually going around semi-urban and rural areas, and where most shopkeepers said that their sales were not back to pre-COVID levels. I mean, it was an eye-opener for me, and this was also, I mean, it was funny in some senses, because we talk about this only the top end doing well, and that report said that right from jewelry to underwear, the shopkeepers were saying that only the high-end stuff is selling. So it was like...
Yes, consumption has become quite peculiar in our country at this point.
So which is, I mean, which is why for the listed space, it might even be a good thing, because they might be catering to the more affluent customer. But, right. This, if you look at the economy, it's a different story.
Right. So, the point is that whether we, the former CA, KV Subramaniam, he said, I think yesterday or day before, he said that if you have to, we'll have to be consistently growing at 8% thereabouts or higher for a sustained period of time if we have to get anywhere. And for that, we need to look at clearly, we need to look at growth opportunities, right? So I'll come to Abhishek Poddar and Rajiv Dhar. Abhishek, you first. What are the growth opportunities there that can take this economic growth? I mean, I'm not even breathing about double-digit, growth at this point, because that doesn't seem very likely, even though I may be short for it. But 8% plus on a sustained basis, how can we grow like that? What are the areas to look at?
Yeah, no, thanks for having me over. In terms of the opportunities, the way we look at it from an investor's perspective, I think we find several green shoots coming out, and lots of new interesting opportunities. Obviously, a very, very large investors in infrastructure, and infrastructure has been at the forefront of investment, both by the government and hopefully coming in from the private sector as well. So that continues to grow, and India continues to be a significantly underinvested, right? There's a study I was reading which said we need $1.5 trillion of investments by 2030 in pure infrastructure itself. Right?
In just infrastructure?
In just
road infrastructure?
Roads, airports, ports,
right.
Urban infrastructure. a broad range, but that itself will just be good enough to see the kind of 7-8% growth that we are talking about, right? Leave aside the developed economy. The other set that we are getting very excited about, and we continue to be very excited, is about the entire investment in the decarbonization, whether it's renewables, whether it's the new energy like electric vehicles, battery storage, and likes of those. Primarily because as the economy grows, we will continue to consume a lot of energy, but that energy cannot be consumed the way and cannot be used the way other economies develop, which is by burning carbon. It needs to be done through a clean energy mode, right? And that's where, to be fair, this government has been at the forefront of driving some of these agenda on the green energy side, and that's how we as Macquarie, we've taken a lot of positions. And I can also speak from a broader investor set globally as well, continue to look at those opportunities as well. The third area that we're tracking very closely is on the manufacturing side, though I must say I think Devina, as you rightly said, we've been stuck at that 13 to 15% manufacturing to GDP ratio perennially, it seems, right?
No, we were at 17 and a half for 5 of the 6 years from, I think, 2008 to 13.
Right.
So we were at 17 and a half. We came down to 13,
right,
which, as I said, was last reached in 1969. So we've been above that since 1969. So after 50 years, we've come to that.
Yeah. There you go. Though what we hope is with change in the global supply chain as it is playing out, the fact is investment is going out of China. No fresh investment or significant investment is going into China, though while a lot of talk is for the onshoring of manufacturing, the fact also exists that US, Europe are very expensive destinations to manufacture, right? So that's where I think we are also seeing some green shoots and early opportunities coming into the manufacturing side of things. Though currently our value add on manufacturing is very limited, and that's where we really need to go up on the value chain.
Okay, so
I'd just like to add one small thing, that we're talking of 8% and 10% growth, but the only time India grew at 7% for 7 out of 8 years, I think, was 2003 to 10. That's it. So, I mean, it's not very easy. If you look at the history of the world, only China had this 10% sustained for decades on end. South Korea and Taiwan to a lesser extent. So it's not something that's easy to do. So it will take a lot of effort to get there.
Yeah, which actually reminds me of one more point, which I'll leave aside for now, but I'll come to Rajiv. Rajiv, significantly underinvested in infrastructure, Abhishek says. Are we still significantly underinvested? You are the right person to answer that.
Sure, but thank you for having me here, and thank you, the panel here. So let me just start by, I just was reading something in the morning, and I thought and I noted it down. So do not be overwhelmed by the enormity of the challenges we are facing. It's not incumbent upon us to finish it, but neither we are free to abandon it. With those kind of sentiments, I think whether it's 7, 8, I think India is on the right track. From a policy, whether it is fiscal policy or even the regulatory policy, I think we are on the sound track. And coming back to infrastructure, I agree with Abhishek that I think the future for the next 10 years is infrastructure, and specifically with regards to the clean infrastructure. And energy plays a very important role. So just to give you a quick introduction about NIIF, we manage about $5 billion. Out of that, about 50% is infrastructure core, and another $2.5 billion is on the other direct, indirect investments in private and growth equity. On the infrastructure side, I think the future is bright, because we believe that the regulatory framework, specifically with regard to some of the large, I would say, segments of infrastructure, whether it is roads, let me call it as transportation, energy, I think are quite established. There are good business models where international investors have seen a good track record with regard to their investment returns, and we are one of them. And from a future strategic perspective, I believe that we think we would be looking at the concept of EAT, which is expand, clean energy, accelerate sustainable, what you call as solutions. And I think on the manufacturing side, while others are investing in the direct manufacturing, I think there's a huge scope with regards to transforming companies to decarbonize. And I think these are the three large elements where the private investors would definitely make superior returns. And from this three-pronged strategy, I think there are four emerging kind of markets within India which are coming up, which is energy transition, industrial decarbonization, sustainable living, and climate technologies. And I think as investors, and many of our international investors are really focusing on these. And I think I'll just end up by just saying that I think the success story is how do we catalyze public capital, which is government money, and with the private investments, and give it a color of making sure that it is backed by sound economic models and returns. I know that there are some projects which have to be done for public good, but I think there are large number of projects which can be actually put on market through a proper return, both from the government as well as from the private investors.
Okay, short answer to a very short counter question, which is when you're saying that we are, in fact, you're agreeing with Abhishek that we are underinvested in infrastructure. That means you expect more of the public capex to come in as we go ahead, or do you?
Yes, I do believe so, but I think government has also become quite smart. I think they have understood the catalytical impact their equity and their money can play. So I think, so I'll give you our example. Our infrastructure project, fund, which is a $2.5 billion fund, government has invested about 50%, about 1.1. We have catalyzed projects to the extent of approximately about 1 lakh crore. So 8,000, approximately 10,000 crores of money which the government put in through us, the catalyzation impact at this stage for those infrastructure projects about 1 lakh crore. And I think there are many other models which the public, the government and its arms can actually catalyze and fast track investments. And obviously we need to also make sure that the money is being invested judiciously, the capacity and capability of implementing those projects are properly governance around them, and making sure that then the returns to both the government and the private investors through PPP model, and there are many other models. Those models are kind of robust, and then adequate returns are being provided.
Okay, awesome. Point noted. Now, Saurabh, of course, is one of India's foremost equity strategists, and if you guys want to make money, you should catch him after this panel discussion gets over, right? But before I ask you about markets and investment in markets and how the markets have changed and how they are going to change further, a generic question before that, I was speaking about K.V. Subramaniam and his point, right, that he made that we have to grow at 8% on a sustained basis to be able to create jobs and reduce poverty. Of course, there has been a lot of discussion about multi-dimensional poverty, which is a different thing. I don't think KV was referring to that. But what is your feeling about this whole thing? Because even from a market perspective, if you look at it, right, you are looking at all sorts of industries and all sorts of activity going on around you. 8% on a sustained basis to create jobs, is it easier said than done?
So, Lokesh, the way I'll attack that question is, I don't think the number being 7 or 8 or 9 is going to shed much light on the issue of where we are heading, right? The reason I'm a bit skeptical of aggregates is, if I tell you my body temperature is say 37 degrees Celsius, but if my head is on fire and my legs are in ice, it hardly tells you anything useful about me, right? So I think the 7 or 8, 9, I think these are almost useless numbers at one level. From what we can see in the government data, and the government is putting out tons of very useful data, folks. I mean, a lot of credit to the folks in Delhi. This data is available freely on government websites. There are 3 mega transitions happening in India today. 3 massive transitions which go to the heart of both the issue you and the erstwhile CEA is raising about the poor, and I think it also addresses the point Devina is making about super rich consumption. First transition is, in the last 3 years, SME profitability has gone through the roof. So the government puts out, basically from the income tax department, you can see for every strata of corporate profits, how quickly are they growing. So 0 to 5 crore ka profit category mein, what is profit growth? 5 to 10 crores profit category mein, what is profit growth? So on and so forth. You can slice up the entirety of corporate India year by year into various profit buckets, right? What you can see is that basically up to FY20, SME profitability was absolutely getting plastered. Last 3 years, SME profitability has taken off, right? Now, why has it taken off is probably a different panel and a different discussion. But I think one of the first things we should be very optimistic about is chota businesses, laghu udyog, right? 50 crore, 100 crore, usse bhi niche, right? Small businesses are earning bumper profits. We haven't seen this before in India for a long time. Why they're doing so well in the last 3 years can be a subject for a broader discussion. One of the reasons I think high-end consumption is doing very well is I think the owners of these businesses are living it up. And why shouldn't they? Right? They had a torrid time for many years. And last 3 years, small business profitability has shot up. And the owners of these businesses are choosing to buy nice SUVs and jewelry and so on and so forth. And we in the stock market can perhaps make a little bit of money from that. The second transition is coastal India or peninsular India. Peninsular India's economic growth has taken off, right? So many of the states in southern India, many of the cities in southern India, GDP is doubling every 6 to 7 years. These are the fastest growing cities in the world. These are the fastest growing regions in the world. 6-7 saal mein economy double ho rahi hai. And this is in our country. This is not some Japan or South Korea or Taiwan, right? In our own country, big swathes of peninsular India, growth has absolutely gone through the roof. A lot of the investment within India is going to these clusters, places like Hosur, the Pune, Nashik triangle, the Chennai area, Hyderabad, Telangana, Gujarat. So wherever you have well-developed peninsular markets, good infrastructure connectivity, good law and order, you're seeing growth take off, right? So this is the second big transition. And the third transition, perhaps the transition which should give all of us the greatest cheer. Data from the Reserve Bank of India for the first time suggests in urban areas, women have more money in their accounts than men for the first time. FY23, first time RBI data is showing us that in urban areas, women have more money in their bank accounts than men. And by the way, women also have more bank accounts than men. So not only do they have more money in the bank than men, they also have more bank accounts than men. And that translates that sort of correlates very nicely with the educational data that we are getting. At every level of the educational system now, from kindergarten through to university, more girls are studying than boys, and the pass rates for women are through the roof compared to the boys, right? So who would you ideally want to be in the future, right? Ideally, you should be a woman entrepreneur, woman SME owner living in peninsular India. Life is sorted for you. You'll do really well. And if you want to look at the other side of the coin, on all issues on poverty, unemployment, if you're a man poorly educated living in East or Northern India, life is a different ballgame altogether. So the aggregates are a little meaningless. There are huge swathes of our country, the SME community, the SME ecosystem, peninsular India and women on the ascent, doing very well, powerful forces. These bode well for the country, but there are also obviously big pockets of concern.
So women have more money in their bank account. Big cheer for all the women in this room and the country. Thank you. That's very, very encouraging. But, as a journalist, my skeptic, devil near me is asking, is it because the men are necessarily having less money, or is it because they are putting all their money into stocks?
I used to also hold these sorts of, chauvinistic views, right? I'll also give Mint credit here. 10 years ago, I remember this. 10 years ago, it was a Mint headline. I remember that day vividly. Mint headline 10 years ago, more girls in primary school than boys, right? So, and I felt that day the country was changing. Right? It was a Mint headline, and you guys do a wonderful job of covering the educational piece. But coming back to the core subject, no, I don't think, a lot of men like me sometimes feel that women have more money because we are doing all the kharcha. I'm not sure that's actually borne out by any realistic data. The data is showing women are earning more. There are IT industry surveys now show that women earn more in the IT industry than men. Even in the manufacturing sector, there are several car factories now which are all women. Tata Motors, I think, has one. M&M has one. The entire car factory is women. And if you ask labor contractors, I'm not talking about white collar, I'm not talking blue collar. If you ask labor contractors, they will tell you that the most prized employees in factories now are English-speaking women who can run factories, right? So the world is changing in front of us. The government's data is doing a wonderful job of capturing the change, just that we tend to get lost in these inane debates about GDP 7.5 aayega ya 8 aayega, and unfortunately that question is actually at many levels not going to tell us much about India's future.
It only gets us the headlines, you know.
Absolutely.
That people tend to want to read. But Mehul, one of the points that, you know, before I come back to Saurabh and Devina and on the markets where they are masters, the point also is that with the South Indian, you know, development that is happening that Saurabh pointed out and so much of other things happening, there is another report, and this time I will not name the thing, but another report that says that actually investments in India are being led more by private real estate demand than by public infra capex, which was quite a surprise to me because, you know, everybody is talking about public infra capex has been driving investments and driving growth and all that. What is your feeling about this?
See, the overall investment and the capital expenditure which has been happening, we have to look at it in totality. I fundamentally do not see anything wrong even if real estate is actually driving the things, because that industry has cross linkages with a significantly large number of industries and the segments, right? So at any yardstick, possibly around 250, 300 odd segments are linked to the real estate. But broadly speaking, even if you look at the overall capital expenditure trajectory, over the last 10 years, this has changed fundamentally from a 2013-14 around 12 odd percent to around more than 20% now from the government side, right? So that's a significant jump that we are witnessing. Abhishek had been elaborating in terms of the need for the further infrastructure on this, right? So from that angle, that push indeed is coming, and that's not something that one can just be putting as a figment of imagination. Having said that, from an angle of the importance of the real estate sector also driving, I believe that number one, because of its cross linkages with the other industries, it's an important driver. Second aspect is that a lot of job creation is happening from that industry as well. So that also makes it very important. And third thing is that, is the growth likely to be sustainable in the future? As of now, hopefully, there are no bubbles that are getting created in that sector. Looking at it from the other side, the constant push from the government on the affordable housing, as also the demographic, I would say, the pattern that is emerging and is usually being analyzed, and many reports state that the housing investment in India, I mean, people tend to invest it at, in the late 30s as compared to what happens in the other developed economies. So from that angle, I mean, two-thirds of the population is potentially going into investment in the housing. So that can spur the demand. And if it is coming from that sector, I don't see anything wrong in that.
No, nothing wrong in that, absolutely. It's great to know and should have more of it, which brings me to back to Abhishek before I come back to the markets again. But private capex, I've been hearing some nice things now. Really, are we seeing animal spirits out there? What's your take?
You could need to go back to history to understand today, right? But a decade and a half, huge amount of capex cycle was done by private sector.
Yeah.
Lot of that, and that went into sectors like cement, steel, thermal, sort of things. Many of those, for various reasons, did not make money. Then we had a situation where the banking crisis happened and the capital wasn't available. So the real animal spirit that India is so known for, etc., really took a beating when it came down to the period of 2008-10 to 2020. And trust me, as investors, you know, memories last long. When you lose money, memories last forever. And many investors, private sector investors, including foreign investors, have lost money. So don't blame them when once burned, twice shy, and that's the situation for the history. Having said that, I think the broader narrative about the future India being on a trajectory which is broadly positive. is been well established. Hence, I think the number of announcements. In fact, I was reading a news article which was saying that in last year, the number of private sector projects that have been announced is more than the cumulative of last 5 years in total, right? So people have started to take steps. The good news is our banking sector is unclogged, so there's credit available. There's enough foreign capital which is looking at coming into India. I was just sharing with the panelists before this. In last 2 months, I have personally, there have been 4 fund managers or pension funds from Australia who've come and met me just to understand what's happening on the ground, right? And similarly happening from many of the other investors. So there is significant amount of capital which is looking to get deployed. And I have no doubt as the utilization of the invested capital or invested capacity goes up, you know, we will have more and more of private capex coming.
Wonderful. Let's move to stock market investments. And really, it's the small cap, mid cap story that has caught everybody's imagination, good or bad, and good and bad, right? Both ways. But Devina, your organization has, has the sort of, what should I say? I'm missing the word for it. But, you know, it has put out a lot of bubbles. Many of the bubbles that have happened, you have actually burst them, right? What about this bubble? You know, Madhavi Puri book has been saying about froth in the markets. Saurabh is saying small companies are going like anybody's business. Their profits are shooting. So if the profits are shooting up, you should be investing in them, right? So what's happening really?
So, I mean, I look at the market in 2 parts. So one is that the broad indices, etc. So, I mean, all of us have this thing in mind that equity markets give you 15–16% over a period of time, because that's been since the Sensex started, for example, that's been about the compounding. But on all of us, if I ask everyone in the room, they will say, yes, equity returns are volatile. But what people don't realize is how volatile they are, not just on a 1 or 2 year basis, but on a whole decade basis. So while the average is this 15–16%, the variation in each decade is very dramatic. So in 1980, if you had put in 100 rupees, in 10 years you would have got 700 rupees. In 2010, if you had put in 100 rupees, in 10 years you would have got only 230 rupees. So that whole decade, that 2010 to 20, you compounded only about 8.8% at a time when fixed deposit rates used to be 8%. So you effectively got no excess returns on equity. The reason why I'm giving this data is that when you step back, you see the pattern. So that's why when after 2020, that COVID bottom, the market started going up, I was quite certain that, you know, once it's out of that kind of the thing, there is room to go up. And even now, you are not above the trend line. So the risk of a big crash is when you are above the trend line. You're not even at the trend line. So the mainstream indices, I don't see a lot of risk. Where I do see risk is the frothy part of the market, which is the small cap, micro cap. Of course, SEBI's definition of small cap, mid cap keeps changing, because now they have made it that, you know, top 100 stocks, next 250 stocks. So it's not market cap based anymore. I mean, to my mind, you should be super careful with anything below 5,000 crore market cap. We don't even look at anything below 1,000. Between 1 and 5,000 also, we are very, very careful, because investing is a loser's game. You win if you don't lose. So first principle in investing is not to lose big money. And since there are many, many new investors, they do not have that history. And what does history tell us? That in 2008-9, the small cap index fell nearly 80%, 78% to be exact. That index level came back in 2016. And then you had a 1.5 year grand bull run at that time also in small caps. And then again, you had a nearly 2/3 fall, a 65% fall. And I always say, don't forget your school mathematics. When something falls 80%, it will go up 5-fold and you are at 0. If something falls 2/3, it triples, you are still at 0. So a lot of micro cap, small cap managers are here talking about a 50–60% compounding in the last 2 or 3 years. But if you go back 5 years, you would find that, you know, it had gone down 90%, and that's where you are compounding from. So, and also see in small caps, coming back to the losers game stuff, it is like that in small caps, unlike in large caps, you can't manage risk by, for instance, putting stop losses, because when the stocks fall, there is no exit. And while theoretically I'm saying the 2008 index came back in 2016, it was actually a completely different index, because the small cap index churns 18–20% a year. In 5 years, it's a different index. So many of those stocks just go into the great blue yonder. I mean, today only about 4,100 companies trade actively. There were many more companies that have been listed in India. If you go back to the 90s, there were years when there were 1,200 and 1,300 listings. So many of them have vanished into air. So basically, be very careful on the frothy ends of the market, but otherwise, I don't see very big risks where we are today.
Right. Saurabh, so your point, your view on the whole froth issue, plus also the fact that seems to be a systemic kind of change happening in the markets, where earlier, you know, whenever the FPI money would be pulled out, the markets would tank. Now it's not happening because the DIIs are pumping in money, which they would not do earlier or not have. And the amount of retail investment that is now there in the market is significantly higher than what it was even pre-pandemic, right? So is this a kind of a permanent change, and it links back to the bank accounts and whether I have money in the account or I'm putting it in stocks? But the small cap, mid cap bubble first, and then the FDI versus DII.
So let's do the good news first, then I'll come to the bad news. So the good news is the data on financialization is actually reasonably easily available, and it's very compelling. Yeah. So by financialization, I mean not just bank deposits, but mutual funds, AIFs, PMSs, insurance policies, and so on. And roughly, if you add up data from IRDA, SEBI, and RBI, Indian households are investing somewhere between $150 to $180 billion a year into the financial system. Right? These are colossal flows. These are flows even I wouldn't have dreamt of even 5 years ago. Right? These are massive flows into the financial system. $150 to $180 billion, adding up all assets. And these are flows. This is not a stock. The stock of household financial savings, I suspect, would be north of $1 trillion, but the flow itself is a very punchy figure. And in the context of the stock market, as you rightly said, Alokesh, what this means is even if the FII runs away, as the FII ran away in FY23, the stock market doesn't plunge because the mutual fund flows buffer the FII exits. That's the good news. Now, the not so good news is, Devina's mentioned it, you've had demat accounts rising from, I think, 30 million 4 years ago to 140 million now, right? It's almost 5x growth in demat accounts in 3 years, right? And I think Neil Borate and his team do a wonderful job of writing about this subject. Now, what you can see again in the SEBI data is a big part of this new demat account money has gone into small cap, right? So the SEBI data shows retail participation in small caps has gone up, and naturally, therefore, if the inexperienced money has gone there, that's where the bubble in the market is most likely to have formed, right? Now, thankfully for those of us who work in the market, there's an antidote for this, right? The antidote is the foreign investor in the Indian market has actually taken a back seat over the last couple of years. First year after demon, the foreigner was very excited, a lot of money came in. But FY23, the foreigner went away. I think there were outflows of 15 to 20 billion. FY24, there have been inflows, but nothing like what you would expect to see. Now, I think there's room for optimism here. Foreigners have invested $3.5 trillion in the Chinese market, Chinese stock market. Foreign investment is $3.5 trillion. The Chinese stock market's 10-year dollar CAGR is 4%. Right? 4% dollar CAGR, 10 saal ka, on $3.5 trillion of foreign money. Foreigners have invested in India $500 billion. Their 10-year CAGR is 14%. I don't think it takes sort of wild stretch of imagination to say, even if $500 billion of the 3.5 that the foreigner has put in China, even if $500 billion of that comes towards India, that would be a sensible reallocation by the foreigner. I'm being conservative here. If they put $1 trillion here in India, I don't know what we'll do. So I'm saying let's conservatively assume of the $3.5 trillion that foreigners have put into China, they redirect $500 billion into India, thus doubling their investment in the Indian market. Let's further assume they do this very gradually over 10 years, right? Zyada jaldi nahi, 10 saal mein. So they put $500 billion into India over 10 years. That would be $50 billion a year from the foreign investor. And that I think then brings back large caps to a situation where they get some sort of valuation parity with small caps. Because the large cap to small cap valuation difference now, or put it like this, large caps are the cheapest they've been on price to free cash flow in 20 years relative to small caps. We have never seen the situation, valuation gap between large caps and small caps, where small caps have been inflated to high heaven on the back of retail investor inflows. I think the foreigner will come in and take that arbitrage away. And as the foreigner runs away from China, you should see a recovery in large cap. Hopefully the retail investor will not get too burnt. Hopefully the regulators' warning on froth would have acted as some sort of signal to retail investors to calm down their enthusiasm for small caps.
Can I just add something to this, which is that, you know, in most interviews I'm asked that, how do you think the FPI flows will be? And I was there at the beginning. In fact, I resigned from Citibank because the Indian market was open to foreign institutions. So 1993, Dr. Manmohan Singh's budget. But what I found was, and at that time there was not much of domestic institutional money. There was only UTI, LIC, etc. And this was a huge new inflow of money. But 1994 is when the inflow started, this like huge amount of money coming in. And 94 to 2003 is the only 9-year period in the Indian index history which gave zero returns. Even on a month-to-month basis in the beginning, we used to track, and we found there was no correlation between the FII flows and the market direction. In fact, the first month, the FII flows turned negative, the market went up. Now I don't even track it except from the balance of payment perspective. So every time anyone asks me this question, well, how will FII flows be or FPI flows be? And I say that, have you seen whether there's even a correlation, let alone a causation of market moves with that? There is none. I mean, you actually do the data.
In fact, if you look at FDI data, since you relate to it, and I'll take this question to Rajiv and Mehul, you know, FDI in India, according to an RBI report, I think there is FDI in April to Jan this year has shrunk by 38% net, right?
This is largely, this FDI data is largely PE and VC flows, right? So a lot of people reference it. Don't take it too seriously. This is basically the same funding winter that was being referenced in Ravi's discussion with Kunal. So when the PE VC flows return, that FDI data will show positive. That doesn't mean much.
The only thing is that in the 2014 to 2023 period, FDI inflow has doubled, right? Whereas last year it fell quite a bit, which means that the growth in the previous years must have been much higher, right? When the boom, so-called, the boom that we saw in startup funding and all was happening. Where do you see the FDI situation now? You know, we are almost run out of complete time. So Rajiv and Mehul, Abhishek, just jump in.
I think on the FDI impact and especially on the startup side, yes, there has been an impact. There has been the funding winter which is impacting them. But nevertheless, we do feel that we are now in a position where we should be taking a significant uptick on that. And correspondingly, I think it will be having a reverberating impact on the growth in the other segments as well. So yes, FDI does have an impact, but India has come to a stage where inflow and outflow of FDI is no longer going to be determining in terms of what trajectory we should be having ultimately, right? So irrespective of what this thing, in the past, yes, in the past, the moment there had been a significant FDI outflow, we were impacted very devastatingly, but no longer. I mean, we are still able to sustain that thing, and I think that that would be the course for the future as well.
Yeah, I mean, to Saurav's point, don't look at 6 months, right? And I can tell you from a pure private equity VC side of things, last 1 year, none of us were investing big. The cost of capital has gone up. The valuations had not come down, right? And world over, all of the investors, including us and many of our peers, are sitting on immense amount of dry powder. 24 seems to be different. Our view is the investment in M&A is going to come back with a bang globally. India will benefit out of it, right? So we should speak about this a year down the line, especially the long-term money that will come into the country.
Rajiv?
Yeah, I agree. I think FY23 FDI was about $42 billion. If, that's our internal assessment, and obviously also from the published data. We don't have FY24 numbers, but we do believe that post-election, there is going to be a huge interest. We are right now raising money for 3 of our funds. We believe that we would be very successful based on the feedback we have from international investors. There is so much of, I would say, positivity behind India's, brand and name, and our own company's internal targets are to raise almost $500 million a year minimum. And we do believe that there is enough, I would say, demand for that, for us to ultimately, channelize these monies into various, I would say, platforms and companies in which we are invested, and even bring in new companies in the infrastructure space. So very much, I would say, positive about we as company raising money, and obviously, I think we'll beat both 23, 24 numbers in FY25.
Wonderful. Actually, I have a lot more questions, but we have completely run out of time. It's saying time up here. Anybody's got a question? I have time for 2. One from you, sir. Alternative investment fund, right? Yes. Short, please.
Yeah, I'd like the panel to comment on one observation, which is from January 1st to March 31st, the Sensex has returned 2.6%, as far as I can calculate. So what is the projection for the entire calendar year? And the second question is, if you all think that small caps are overvalued, is it time to sell?
Is it time to sell small caps, Devina?
Yes, certainly. I mean, see, small caps is a very broad segment with many things in it, but you should certainly limit your exposure very much in that and be very careful of where you are invested. In terms of 1-year index target, I have never given it in my life in 30 years, whether in January or April or the new Samvat. And I got the right word for it only last year in Daniel Kahneman's Noise. He says that this comes under the category of objective ignorance, not just something you don't know, but it is something you can't know. So anybody who gives you an index target, ask them last 10 years what were their projections and what was the reality. Then you'll have an answer.
Okay, Saurabh, I know you have figured by now that you don't like big headline numbers, but he's asked a pointed question. What is the Sensex going to be by the end of this calendar year?
So look, again, I think the targets I won't give, but I'll give my own experience of investing over the last 12 months. So my savings, much like Kunal, all of my 90% of my savings are in Marcellus's products. So our large cap product, 1-year return is 25%. Thankfully, that's where the bulk of our savings are. My wife would have killed me otherwise, right? So that's given 25%. Our small cap product, our 1-year return is, I think, close to 0, right? And our mid cap product, our 1-year return is, I think, 14%. So I think you can see my point, right? Everybody out there, the Indian stock market will do well. The country is in a good place. The stock market, remember, will suck out the best of India and make it available to you on a platter. Look for large, well-capitalized, well-managed companies for the bulk of your savings. Have a small portion of your savings in small and mid caps. Don't get too carried away when small and mid cap is rising and your neighbor says, "Boss, mera portfolio double ho gaya hai." Let the neighbor say that. Stay focused on having a small part of your portfolio in small and mid caps, 20, maybe 30% most. Make the core of your portfolio high quality, large cap Indian companies, and you'll do well as the country does well.
So, we unfortunately don't have time for any more questions. Any more questions you have, you can take offline with the panelists. They are here only. One expert on mutual funds, I'll not name him, had once told me that the best thing you can do, anybody who wants to invest in a mutual fund, just go for an index fund and don't think about anything else, right? So on that note, we'll conclude this. Please give a whole huge round of applause for our panelists.